American downfall, horrific financial predictions, condition critical. When the stock market crashed, it wasn't just your stocks and bonds that got crushed. All kinds of assets were decimated: real estate, commodities, and foreign stock markets. And now, it's just going to get worse as the Fed is raising rates while everything is slowing down and collapsing, crushing your retirement account. You must pay attention to what is happening right now because it will eventually impact your investments, especially when we're getting ready to enter a recession. The second half of the year has been a disaster for many investors. The American populace is likely to have negative inflation in their pocketbooks. With this scenario as a backdrop, investment strategies could change quite dramatically. Hi, and welcome back to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we begin, make sure to like this video, subscribe, and click on the notification bell to stay updated with our videos. Now, let's get to the video proper. What would have happened to your retirement if you were an investor and examined what had transpired in the first half of the year? How were your investments doing? Not only have you seen significant losses on your equity investments, but your bonds, which are meant to serve as risk mitigators, have also taken a huge blow. Thus, you've encountered enormous difficulties with noticeably negative results. Your risk mitigation and correlations were utterly ineffective, and the market has been somewhat erratic. It's reasonable that when individuals viewed their first half remarks, they became furious. Energy and food in particular are expected to be significantly weaker inflation drivers compared to other components of headline inflation. The headline figure will decline, but alarmingly, the core number will remain astonishingly high and reflect an inflation process that has spread across our economy and grown more entrenched. That is considerably beyond the Fed's 2% objective. But what is concerning is the collateral damage associated with inflation coming down since the Fed has been so slow to act. It will decline by the end of the year, but it will be sticky. The Fed began making mistakes 15 months ago. Companies themselves were warning that they were experiencing supply interruptions. Had the Fed listened to them, they would have been much more humble in admitting that they don't fully grasp the mechanisms of inflation. Companies responded to warnings by saying, "We're not sure they're going to resolve themselves fast." The Fed became fixated on this idea, believing it to be only temporary, falling victim to a cognitive trap. In March, when the inflation rate for February measured with a 1-month lag had already reached 7%, quantitative easing was still in effect. Therefore, this disaster was caused by poor analysis, poor forecasting, and inadequate communication. So there are two significant dynamics at play. One focuses on supply and demand. A world of insufficient total demand has given way to a world of inadequate total supply. That will eventually be resolved, but another phenomenon is at play right now, the way that globalization is expanding. And from a sharp focus on efficiency, we are shifting to a focus on resilience. By its very nature, that change is inflationary, but that effect hasn't yet manifested completely. Because of this, it's crucial to prevent the dynamics of inflation from taking hold throughout many different sectors of our economy. Otherwise, we risk experiencing sluggish growth and high inflation for far longer than is necessary. Central banks in this picture hold a very crucial role. They have been granted a great deal of authority and responsibility, and politically independent central banks are vital for the economy's health. They are definitely necessary, but we also expect them to execute a good performance and integrity. When they make a mistake, they should explain why they made it as well as what they did to prevent repeating it. People laugh when the Fed releases its quarterly estimates, and former Fed officials are usually the ones making the remarks. In this sense, we need to return to a situation where the credibility of the Federal Reserve is paramount to the health of our society. When we talk about cognitive traps, we've all grown accustomed to judging everything by GDP, which makes it extremely difficult for us to break out of. Is there a significant possibility of a recession? Yes, and it is constantly rising. Why? The economy is slowing down, hence the Fed is raising rates. 2. All of the key sectors of the global economy are slowing, as the IMF prediction just revealed to us, which is why they described it as gloomy and uncertain. So even while there is a high likelihood of a recession, it is not inevitable. To prevent a recession, there need to be several steps done in 4 areas. First, the Fed must take action to tighten its monetary policy and re-establish credibility in order to control inflation. Right now, its forward guidance is essentially useless, which is not a good thing. It is a crucial monetary policy instrument. Second, we need to use fiscal policy more to protect the most vulnerable parts of our society, which would have substantial economic, social, and political effects. Third, many pro-growth, pro-productivity reforms must be implemented, including measures to boost labor force participation and enhance supply chains. Lastly, financial security. Let's recognize how risk has changed and moved from banks to non-banks, and how non-banks have inspired to take risks well beyond their comfort zone through years of low interest rates and massive unpredictable liquidity injections. The non-banking sector is still in the red, and we must monitor the threat to financial stability since it might recur and hurt the economy. Despite having a little immediate impact, they are still significant. In essence, they serve to facilitate the supply side. We now live in a world with a deficit in both aggregate demand and supply, which is evident everywhere. To see what a labor shortage looks like, all you have to do is step outside. You'll also see what a broken supply chain looks like. It is crucial that we take action to increase labor force participation, and this boils down to fundamental concerns like childcare. The level of female labor force participation still isn't where it needs to be. Numerous opportunities exist for public-private partnerships. In order to understand how successful private-public partnerships may be, we need to take note of the positive things that occurred throughout the pandemic. We also shouldn't lose sight of the fact that this is an international issue rather than just a national one. Therefore, collective effort is crucial. Having said that, there are some silver linings if you look forward to it. One is that we are beginning to see entry points for excellent long-term investments as values become more realistic. Instead of being general, they are selective and unique. They are not purchasing the index, instead, they are buying a few companies that, given the fundamentals, have been significantly over-contaminated. We are also finally seeing bonds return to their traditional role of reducing risk. Why? Because the risks of interest rates and inflation have played out, and we're now looking at the risk of a recession. And last, we came close to establishing a third risk element that combines with the first two, namely the market functioning risk. The good news is that we could navigate through the repositioning that individuals needed to do when liquidity was particularly strained. We have weaponized the global payment system without standards, protections, or other measures. And if you belong in the global south, you will begin to wonder whether you are vulnerable to a dollar-based system. If we are not cautious, we may wind up fragmenting the whole economy. Russia is a member of the G20 and as the 11th biggest economy in the world, or was the 11th largest economy in the world. Before its invasion of Ukraine, the idea that you would sanction its central bank, remove it from the payment system, and prevent it from settling into the payment system was something that was nearly inconceivable. This represents the nuclear weapon of sanctions. Sanctions on trade, sanctions against specific people. There is a mechanism in place to control commercial sanctions. But this was a completely unique situation. It's quite potent, and without carve-outs, it might drive an economy to its knees. It sounds like we've reached the end of this video. If you found this video helpful, please hit like and subscribe, and tell us your thoughts in the comments section below. This is Finance Sense, helping you keep up with all the latest trends in the financial market and the economy. See you next time!